welcome. You're watching Talking Point. Vikas Pershad, the portfolio manager, M&G Investments, joins us from Singapore. Hi, Vikas. Thank you for taking the time out to talk to us this morning. Vikas, before we go into nitty-gritties, what are you feeling? The world is looking tough. I mean, on one hand, you've got those big elections lined up, not just in the US, but in most parts of the world. You have geopolitical stress, which is as real as it can get. We've been uncertain for quite some time now, but it seems like our valuations are playing catch up. China is coming out, but of course with stimulus packages they talk about, but we've seen no pen to paper just yet in that sense. How do you feel? Do you feel it's risk-off trade for the foreseeable future now, for at least Indian equity markets or emerging markets as a pack?
Hi, good morning. It's difficult to predict short-term movements. What I will say is that as a global investor, in a global context, Asia looks pretty good. China looks good, Japan looks good, and India looks good still also. Our time horizon is long enough that these the short-term volatility is less impactful to our portfolios. Our positions are large enough that we don't trade in and out. There are days like today where you're seeing acute pain in one sector, the auto OEMs, and then also that's flowing into other areas as well, two-wheelers, the auto ancillaries. And so we took advantage of where some of these stocks opened this morning to add to our exposure. And what we did do heading into earnings season, because of what we thought were markets that were more resilient than perhaps they should have been, given geopolitical risks, we reduced the name count in the portfolio, we consolidated our holdings. So in the two-wheeler space, we now only own one of the names. Earlier in the year, we owned 3 of them. And so that portfolio management has been helpful so far.
Because, you know, we keep complaining, and in fact, investors complain about India being an expensive market, and we've been expensive, a very expensive, high growth market from the time I can remember. Do you feel that after this recent correction Indian equity markets have witnessed, there is still some more room to go for us to become better priced? And if one needs to be an investor in this market, better days ahead if you're a buyer?
It depends. It's always bottom up. It's stock specific. What I would say is that the market is pricey, not expensive. The reason there's a distinction in our mind is that if something is pricey but not expensive, it's because that's where the growth is. So if you look at what a 1-year forward multiple is telling you, not so much. In the context of what that multiple becomes, then that is more important. You need to do your work. You need to be very specific, very selective. And that's what we feel like we do. The markets have done well. We have as well. And it's this approach that India is a market for long-term investors. You can't just own the entire market. There are opportunities for alpha if you do your homework. And you have to think long-term. So that works. We've been having this conversation for many years that India is very expensive. I've never really espoused that view. It's pricey, but not expensive. And the longer your time horizon, the less pricey India becomes.
So you're right. From a 10-year outlook, this is definitely not an expensive market, right? But tell me, with your India allocation, are you currently fully invested?
We have been for the past 2 years. The average cash balances that we've had, going back to the big short seller report that came out in Q1 last year, has been close to zero. We have been fully deployed. We continue to see opportunities. When we went through this portfolio exercise over the last 1 to 2 quarters of consolidating our holdings in what we thought were the winners in each sector, whether it's auto OEMs or hospitals or IT services, we did the same thing. We went through the same exercise, and we just redeployed the cash into our core holdings. We did not sit on any cash. But the trick for this year has been, even more so than last year, but there have been many ECM opportunities, equity capital markets opportunities, IPOs, blocks, QIPs, and we have participated in some. Most of them we have not. But we like our portfolio. So if we need to buy something or we want to buy something, then we need to sell something first. So that's what we've done. But we remain fully deployed even now.
Where is that deployment spread across? So you talked about a few sectors, but in that pecking order, tell me, where are your preferences? Where is the bias? Is it towards sectors such as IT and pharma, which are more global facing? Is it to metals, which has a little bit of a China play? Is it to domestic consumption? So it could be auto anchs, like you mentioned, consumer staples. How have you structured that portfolio of yours?
Well, the good thing about the portfolio is it's quite diverse. We own all of these. We are shareholders in auto OEMs, but over the last 2 years, that exposure has shifted from four-wheelers four-wheel passenger vehicles to CVs, and then this year there's more split between CVs and two-wheelers. If you look at healthcare, we have consolidated our pharma holdings, we have consolidated our hospital holdings, but we have exposure to those as well. There's no pattern when it comes to market cap. We're just looking at long-term prospective returns. So in the pharma sector, we have some exposure to companies that are sub $3 billion market cap, and then we own some that are much larger. Hospitals, we own the large hospital companies, but then also some of the small ones as well. So it's a pretty diverse portfolio. We own the metals companies, but again, we've been through this exercise of culling some of the smaller positions and concentrating our capital on what we think are the leaders. What is a clear gap in the portfolio, but by design, is consumer staples. The first few days after the election results came out in June, there was a big rally in staples. We used that rally to reduce our exposure. We have more zero weights in that sector than in any other, and we've consolidated our holding. But it's still into consumer-facing names. It's just not consumer as is defined by the staples companies. So if you look at the air conditioning sector, for example, we are there. If you look at hotels, if you look at real estate, we are very much exposed to the Indian consumer, but more towards the high end now than before, and much less to the staples sector.
So does jewelry stocks, retail companies like a Trent, companies that do lifestyle, so Nykaa show up on your portfolio then at this stage? If it's not consumer staples, I'm guessing it's aspirational spending.
It is aspirational spending, and more on the retail side, less on some of the brands, some of the newer listings over the past 2 to 3 years. Those are fewer in the portfolio, though we are exposed to quick commerce and to food delivery already, and we like that exposure that we have. What we have consciously tried to add this year is exposure to the very high-end Indian consumer. There are some views on how sustainable this demand is. We think that it is sustainable. Something different has happened. What we originally thought was a K-shaped recovery coming out of COVID seems to have become a K-shaped economy. And there's clear acceleration at the high end, whether it's hotels or it's airlines. India's largest airline is adding business class, as an example. If you look at some of the more prominent properties, hotel properties around the world, the suites get booked before many of the lower category rooms. First time we're seeing that. You've seen the demand for large high-end homes in the NCR area. And we believe that will continue to other parts of the country as well. It is not exclusively a focus on the ultra high end, but that is more prominent in the portfolio than it had been. Also, we haven't spoken about PSUs yet. Our PSU exposure on the banking side today is lower than it was heading into the elections. And we had lowered our defense exposure also heading into the elections, but we've gradually started building that out in the recent weeks. The defense companies, I mean, not so much the banks.
Because you did mention that you've reduced your PSU banking exposure, and I'm assuming you've rebalanced that with adding a little more exposure to private sector banks. What about another space that's catching our attention for the last few months now is capital market sectors? So be it asset management companies, broking firms, platforms. There is so much excitement around these, right? Have you taken exposure, added positions to that space? Because if you're betting on the India that is getting financialized, this is a space you must be invested in, I'd imagine.
I agree with that. Asset management, we have exposure to. Some of the companies, it's basically a duopoly in the companies that provide services to the mutual fund industry. We have exposure there. Now, the wealth management firms, I admit that our exposure is lower than it probably should be. So we are continuing to do our work there. I presume that the next time we speak, the exposure that we have to that sector will be higher than it is today. And like with many sectors, we have seen re-ratings over the last 2 years. We have seen an earnings acceleration over the last 2 years. But all these stories are still pretty early on a sector-wide basis. And you don't need to own all of them. You just need 1 or 2 in your portfolio. So I agree with you. This is an area where investors should be spending more time.
And what about insurance, Vikas? Because if you're betting on a emerged India in some sense, insurance is a play that has enough and more room to go. Would you think insurance is a good sort of deal in India? And again, how would you play life versus non-life? Where is the bias?
So this is the same debate we had internally. And we, in the first half, in the second and third calendar quarters of this year, exited the life insurance sector. Our exposure is in the insurance sector is outside of that. So you framed it correctly, and that's the exercise we went through. And we decided not to have any life insurance exposure anymore. That could change over the next few quarters. We'll see how they trade. I would say that since we exited, that particular subsector of the financial market has traded better than I would have expected, but we'll see.
Because you're closer to the action in China than we are. What is going on there? You know, we've sporadically see good days and bad days on the LME with commodity prices moving. But it feels like, it almost feels like the Chinese government is propping up the bulls, right? Because every now and then they'll talk about releasing a stimulus, but we don't actually see that happening. Similar thing happened today. How do you play the metals back directly and also indirectly for an Indian investor who's got a home bias? Would it be a good time to buy into the metal story in India?
Again, you've anticipated something, or you've touched on something that we internally were talking about not very long ago. So when it comes to the Indian metal companies and metal companies across the region and around the world, if an investor's new thesis is to buy because of what's happening in China, we think that there's a bridge, that's a bridge too far to cross. They're not very related. The initiatives on the ground in China are directly to benefit the consumer in the short to intermediate term. It's not so much on the construction side or property side, on the metal side yet, we believe. That is our view. And so you asked earlier what's going on in China. A lot is going on in China, but we're not materially changing our China exposure because of any announcements over the past 2 to 3 weeks. We made a big allocation to China at the start of the year and in the middle of the year, and we continue to be positive on that market for both absolute and relative performance. So that's a separate conversation. We can talk more about China if you like. But when it comes to the Indian companies, again, we have consolidated our holdings into fewer and fewer companies in steel, in cement, in other metals and mining companies. And they are for India-specific, or at least non-China specific reasons.
Because how large is your stock portfolio? How many counters do you currently hold?
Well, this year the count is a little bit higher than normal because we've been participating in a lot of these IPOs. And as you know, most of them are quite competitive, even for the anchor round allocation. So we end up with some small allocations. What I would share is that the bulk of the risk is in the top 15 or so holdings, meaning that if you concentrate our active bets, more than half of that is in the top dozen to 15 or so bets that we have. And then we have some tier 2 players in the same sector, perhaps, or in some of the small and mid-cap space. Also, what I'll share is we have an allocation for small and mid-cap companies. It's the highest that it has been in the past 3 years, but it's not at the max levels. We've been steadily adding to it, again, being very selective. And we continue to find a lot of alpha-generating opportunities in the small and mid-cap space. Again, the longer your time horizon, the better the prospective returns you will find. But the amazing thing about India, the Indian market, is how it has changed over the past 2 decades. There are now 6,000 listed companies in India. You're approaching 2,000 companies with a market cap that exceeds $100 million US. Every sector is represented. Every niche is there. Even high-end, middle to high-end semiconductor manufacturing, it might not be there today, but in 5 to 10 years from now, it will be there. And the right companies are laying the groundwork, even for that kind of exposure. So it's a market that's evolving. If you look at the underperformance last year, this year's not done yet, but in 2023, 70% of the index outperformed. And you look at where the underperformance was concentrated, it was in the large mega cap names that once upon a time were the leaders of the market. That will happen again. Today's leaders won't be the leaders of 5 to 10 years from now. And we're investing in the India that is rising, in the forward India, the futuristic India. And we see a lot of opportunities all across the board.
Because the futuristic India has always got the debate of old economy versus new. And when we talk about new economy, while it's a great conversation, actionables are rather limited in terms of executing those trades or those stocks, right? Would you agree?
Well, yes and no. So if you look at some of the old economy companies, some of the most advanced and forward-thinking adoption of technology, broadly defined, is in the renewable space, is in the construction materials space. It's how software is being incorporated. It's how hardware, robotics, factory automation is being incorporated. Tracking of shipments is being incorporated. So you have some of these old economy stocks, like cement companies, like metals and mining companies, construction companies. But then you also have logistics, quick commerce, food delivery, at the forefront of technology adoption. So when we talk about the India of the future, we're talking about a lot of these sectors that are leapfrogging way stations along the way that someone might have expected. So for example, one of the best examples people talk about or have talked about in the past couple of decades has been the telecom sector. That most of India went from not having a landline to straight having a mobile phone. We're going to see that leapfrogging in other sectors as well. Quick commerce is a good example of that. We've gone from talking about a structured retail sector that is less than 10% and how that will play out on the organized retail side, looking at it through the lens that we view Western markets. But then now you look at the adoption of digital payments and quick commerce. That's another leapfrogging event that's taking place. And this is going to be very large, and we hope to be exposed to that sector for a long time.
Because you mentioned you've subscribed to quite a few of those IPOs that opened in India, and the returns of those are phenomenal. The subscription numbers are eye-catching. We have a significant big one that is open today. That's the Hyundai IPO, right? And I think it's somehow causing the other auto stocks to give up some gains because I'm assuming auto funds are rebalancing as we see it. Do you have a view on this one?
Well, directly on any specific IPO, I'll hold back from commenting. But I will say that we are probably nearing a peak level of activity when it comes to QIPs and large IPOs. But a deceleration won't be bad; it'll be healthy. But when you have multiple multi-billion-dollar IPOs and blocks coming through in a very short period of time, that does absorb a lot of the liquidity. What has been impressive to me is how much liquidity there actually is and how much continues to come in every month from the domestic retail investor. So I think that will continue. The IPO activity will continue. But this has been a pretty frenetic pace that we've seen on the IPO front. Now, all these IPOs are very healthy. I'm not surprised that parent companies abroad, whether they are in South Korea or in Japan or in the northern part of Europe, are continuing to list their subsidiaries in India because of the valuation uplift that you get. But again, this is where the growth is. So we will expect to see those continue to grow.
You know, I agree. I mean, some of these IPOs are phenomenal, but there are others that may not be so great, right? I mean, some of those SME IPOs have been oversubscribed and how, and there's not too much of a story going for them. And I know you can't comment on IPOs specifically, but one good thing they've done is they've ensured that there's some of the liquidity moves there, and that prevents some form of a bubble that our markets could have gone into. If you have to give me a percentage of IPOs that you've subscribed to recently, would you be able to do that?
It's low. It's low. We evaluate a lot of opportunities, and as you know, a lot of these companies, if not all of the companies, do come through Singapore. I get to meet them. It's heartening to hear their stories and where they've come from. But again, we like our portfolio. As I was saying earlier, if we want to buy something new, then we do need to sell something. We're not sitting on cash. We are fully deployed. So we have to be very selective. The hurdle for investing in an IPO is higher than it is even for companies that have been listed for a long time, because the information asymmetries are too high for us to be participating very frequently. But we are spoiled for choice. Small IPOs, large IPOs, mid-size IPOs in the automotive sector, textile sector, hospitals. I met two companies just yesterday in the B2B sector and in the hospital sector. I have another couple lined up for today and tomorrow. So it's a very active market. It's good to be busy. It's better to be busy than not to be busy. It's good that these companies are looking to get some liquidity. What's also encouraging is that you're not seeing founders materially cash out. These are largely OFS type deals. There is primary capital, but it seems to be going for good purposes. And it seems to be functioning relatively well, the IPO market. SEBI's done a very good job of vetting IPOs and delaying IPOs if they're not satisfied. So we're getting very high quality options to choose among.
So for all that incremental money that's coming in, Vikas, are you adding to your existing portfolio of stocks? Or because with all these new ideas, are you getting greedy and sort of building the incremental cash flow with a different portfolio?
Well, I'd like to think that we are always long-term greedy, and India is a good market to be long-term greedy in. But we're because of the valuation uplift that we have seen over the past 2 years, and you see some of that, the impact of that today in the two-wheeler space, when you have earnings going up, but then a re-rating going up much more than that, stocks in the short term can be vulnerable to any surprises that are neutral to negative. And so for that reason, we have consolidated into fewer and fewer holdings. I believe we're largely done with that exercise. So incremental capital that will come in most likely does go into our core holdings, and we will save some for the IPOs along the way. As I mentioned earlier, we think that this IPO activity probably is near a peak. But even a healthy correction from this pace still offers a lot of choice, and that we see continue.
Right, because it's so good to have, got some perspective from you on the long-term picture of the Indian markets. But we all do know while India is in a structural bull market, any bull market is made up of multiple small cycles, right? With everything that's happening around us, we've sort of, in many ways, ignored. How concerned are you about what's happening geopolitically or what's happening, maybe a potential slowdown that we are concerned about? Earnings season so far has been okay-ish, no major positive surprises. Do you feel all that could play catch-up? And I know you're not into predicting, but do you feel like at the end of the year, or maybe next year, the Nifty may be lower than it is today, only because we borrowed future returns?
So you touched on a few things there. I'll say a couple of things. Number one, though we don't make predictions, we do run scenarios. We think probabilistically. And we spend as much time thinking about what happens if things go really well, especially in a market like India, as we do spending time on thinking about what if things go wrong, how do we lose capital, what are the downside risks. So we think that that is a very healthy exercise. Within the realm of expectations for each company that we look at, and as we think probabilistically, we have indeed, over the past 2 to 3 years, widened out our scenarios. When we look at India in particular, the upside looks like either the probability is higher or the magnitude of the upside could be higher in many of the companies we're looking at. But then given the geopolitical risks that you mentioned, we have lowered the potential downside as well. We've raised the probabilities for the wings. We've assumed more harsh assumptions for supply chain disruptions, for less pricing power, higher costs of money, the interest rates being higher, inflation being higher. But I would say if 2 years ago, you had told me that there would be armed conflict in Eastern Europe, armed conflict in Western Asia, potential for conflict between large countries out here in Asia, I would be very surprised by the resilience of the markets. No, we can't time any bear market, and this is why we are fully deployed, not sitting on cash. But we are thinking probabilistically, and we have widened out the scenarios. If all the markets in the world were to close today for the year, India would be the only major market in the world, or the only market in the world to have gone up 9 consecutive years. And because the rupee has been generally stable, even foreign investors who are investing in dollar returns will have gotten a large portion of those returns. That's a big difference between India and Japan. Japan has done very well as a market, but the yen has weakened materially. So if you were a dollar investor, you didn't get those returns. So yes, we might have borrowed some future returns, but we're thinking on a 5, 7, 10-year horizon and beyond. We are looking to be aligned with the promoters of these companies that we're meeting. They're making long-term investments, and so are we. A pullback would be healthy, but on the balance of what we know, we'd be adding to our positions rather than panicking.
And I guess hence it becomes difficult. It was a sectorial call, but betting on the promoter, and I think that is so important for us to all be mindful of, right? If you're making a significant investment, it's very important to bet on the management and have complete faith in what they're doing. But thank you, Vikas. Great talking to you. I'd love to chat with you longer to understand the style of investing, but maybe that can wait until next time. With that, we're completely out of time on this edition of Talking Point. Thanks for watching.